A stock market crash is coming, so what will the impact be on covered call ETFs and how do you deal with it as a PII investor? What's up, everyone? Welcome back to the channel, your number one source for income-oriented investing. I've been getting this question a lot lately, and it's only normal, right? When the stock market is at all-time highs, guess what? There's going to be in the news and the nonsense media, stock market crash is coming, right? It's only normal, and I've been getting questions and concerns about this. Let's just take a look at a few member questions and concerns about this real quick here. Sorry, the writing is small, but let me go through it here. Here is one comment from a member. I look forward to watching more videos in this heightened market. I hope you speak of defensive actions when the market eventually falls. Please keep up the passionate, great work. Here's another one. How do these types of stocks react to a market drop and recovery? With the 25% leverage, does this lessen the effect both up and down? So this is the question I'm going to try to answer in this video, everyone. Let's go through some important points here, and I'm even going to show you some data. All right, so point number one, and probably the most important point to remember in terms of what will these ETFs or what will covered call ETFs do when there's a market crash? Well, guess what, everyone? Spoiler alert, not that interesting. The covered call ETF prices, or the NAV, the net asset value, which is pretty much always the same thing as the stock price, or one couple of pennies more, couple of pennies less, they will drop by the exact same amount of the underlying holdings, right? So S&P 500 drops 10%. Guess what? S&P 500 with covered calls will drop 10%. If it has 25% leverage, well, it's going to drop 25% harder, right? The one with the leverage is going to drop even harder. But in both cases, the leverage covered call version and the non-leverage covered call version, even though it will drop by the same amount or more, they're still generating those call premiums, right? Which tend to spike during a crash because there's higher volatility. So it will offset the drop by a little bit, but it will more or less in tandem do whatever the underlying assets do. This is why I always say to newer investors, you got to look beyond the stock symbol. Okay, you're not investing in this or that or USCL and QQCL and HYLD. You're investing in the assets inside. So if there's a crash and those assets inside go down 10 or 20%, well, guess what? The ETF will follow. And if there's 25% leverage, it'll go down even harder, approximately 25% harder. But leveraged or not, the covered call versions do have a little bit of cushion, which is those premiums, which is that income that's being given out to you, right? S&P 500 goes down 10%, there's barely any income. The covered call version goes down 10% as well, but you're getting that monthly dividend in form of those premiums. So that's basically the cushion. So with the general rule of thumb, let me give you some general rule of thumbs here. Without the leverage, during a bad period of time, let's say we had a bad year or bad 6 months, like 2022, for example, bad month like April 2025, the covered call ETFs without the leverage will typically outperform just the underlying asset because of those call premiums. But the leveraged one will typically still underperform, even though it's generating premium. If there's a sharp drop because of that leverage, during that time frame, it'll drop even harder. Let's check out a few examples here. Before we continue, I'd like to tell you about the Moomoo broker, who is the first broker in Canada to integrate AI into the broker. Just like you can see on the screen here, it's pretty cool. You could chat with an AI bot to ask questions about single stocks like earnings to save you a lot of time. So if you follow single stocks closely, this could be a really cool and fun tool to use. And as usual, for new accounts, Moomoo offers a bunch of welcome bonuses. For example, deposit $100 and get $50 cash back. If you deposit even more, like $5,000, you'll get $200 of cash back plus $100 of credit for options trading, so that would be 300 total there. You have 60 days of commission-free trading. You also get 6% interest on cash on idle funds for balances up to $10,000. So lots of welcome bonuses for new accounts. They also have a earnings season guess and win, which is pretty fun. If you just participate, you could get some cash back, like $10 here. But if you're right, you could win even more. So basically, when earnings season for a particular company is about to come out, you'll be able to vote if the stock is going to go up or down. And if you are right, you could win more cash. So pretty cool. Lots of bonuses for new accounts, guys. I highly recommend you check it out. And I'll put the link to this page as well below, which will answer the frequently asked questions you could have, and will give you all the details on the bonuses and how to get these bonuses, etc. So I took some more obvious examples. Let's check out what HYLD did in April of 2025. So remember, April was a very volatile month this year because of the tariffs. So let's do HYLD versus VSP, which is, for me, is the benchmark, right? So HYLD is, quotes here, S&P 500. It's not exactly the S&P 500, but it's kind of like a concentrated version of the S&P 500. Hedged to the Canadian dollar. It has 25% leverage. VSP, just a Vanguard S&P 500 hedged to the Canadian dollar. You see that HYLD during that month has gone down less, or has underperformed VSP. That is because of the leverage. You see, first of all, the chart follows each other, right? Because it's very similar, if not identical, assets. But HYLD did go down more than VSP during that month. That's even with the covered call premium, because if there's a sharp drop, everyone, even if you're generating a little bit of premium, it's still not going to make up for a sharp drop in a small amount of time. What about 2022? Remember, 2022 was a pretty bad year. So let's do VFV, the S&P 500, versus USCC, the Global X S&P 500 covered call ETF without any leverage. And keep in mind that I'm selecting the funds here because a lot of these leverage funds, for example, have not even been out in 2022. HYLD was HYLD version 1.0 in 2022. So I figure I'll do it with USCC. So this is just the whole year of 2022. You see that USCC has outperformed or did better than VFV during this very bad year. You could see the very bad year in terms of the stock charts here. You see that it was definitely more down than up. So USCC, that uses covered calls, has no leverage, performed slightly better, right? It went down slightly less than VFV, right? So this is just to show you something in terms of what you could expect. This is why I'm showing you this. But it's very important to understand, everyone, that as a long-term investor, you shouldn't really focus on the short term. You should focus on the long term. And if we look at more the long term with these funds that came out in 2023, for example, the leveraged one, if we do HYLD versus VSP more long term. So if we do HYLD versus VSP, starting in January 2024 until now, I'm using that day because that's approximately when it's actually February in 2024, but that's when HYLD became the HYLD that we know and love today, HYLD 2.0. And you see that the total return is very similar. And actually HYLD with the dividends reinvested is currently outperforming VSP a little bit. Without the dividends reinvested, it's pretty much identical. So you could see that long term, which is what you are. If you're watching this video, hopefully you are an investor. You're not a short term trader, speculator, not a short term investor. Over the long term, the evidence points, and I'm sure that as the years go by, it will keep proving that a covered call version of something with 25% leverage performs similarly, not identically. Is that even a word? Similarly to just the underlying asset. Let's take another example. QQCL versus QQC, right? NASDAQ 100 with covered calls, 25% leverage versus QQC, which is the QQQ of Canada, just the NASDAQ 100. Since January of 2024 until now, you see that it's very similar in terms of performance, right? USCL versus VFV since the beginning of 2024, very similar, right? So, big lesson with all of this. What is the takeaway? Well, remember that you should, number one, only be interested in the long term. I'm showing you what could happen in the short term, but you should only be interested in the long term. And in the long term, okay, covered call ETFs without the leverage generally underperform the asset, the underlying asset, right? So, USCC, ESPX, whatever it is, will underperform the S&P 500 over the long term because they don't have leverage, and covered call ETFs literally are giving up upside for those premiums, plus they have higher management fees. So over the long term, which is what we really should be interested, they tend to underperform. Now, if they have 25% leverage like USCL, they will perform a little bit better over time, over the long term. In my opinion, I think that's what's going to happen. They're going to perform more similarly towards versus those underlying ETFs. This is why that's my favorite format, covered calls and 25% leverage. They came up with that to try to narrow the performance gap. That's why it's my favorite type of fund, okay? Next thing to remember, how will covered call ETFs could possibly react? Well, there might be fluctuations with the distributions. They could be reduced a little bit, or they might even be increased a little bit, right? It really depends. The number one factor depends on the volatility, and we know that volatility typically spikes during crashes, during the bad times. So that could help take in more premiums, which means maybe the fund manager won't have to reduce the distribution. They'll be able to maintain it. Again, it depends how long this volatility is. It also depends on what the manager wants to do, right? We know that Hamilton, for example, always holds back 1% just in case, which means there's much less of a chance of a distribution reduction, right? So in Canada, the managers tend to be a little bit more conservative and very, very, very responsible, all of them. Okay, I've talked to all of them. I know all of them. They know that we don't like distribution decreases, but they still need to be very, very responsible, and they do not want to pay out more than what they're taking in. That would be bad rock. So you could expect sometimes some distribution reductions. Maybe they'll re-increase them after a while, but it's just something you could expect. But don't expect a 50% cut. These are not dividend stocks, everyone. If I feel like there is going to be if there's going to be a distribution reduction, it's most likely going to be small. And I've even seen in cases where there's a crash and the stock price or the NAV is going down, that they're actually increasing the distributions. That's probably more going to happen on the US side, but that's because they're taking in a lot more premium, and maybe the fund manager's policy is let's give out everything we earn, which is okay as well. My opinion is fine as long as you're not giving out more than what you earn, right? So expect some distribution fluctuations, but remember, it's not the end of the world. And remember something very important. This is something a lot of new investors don't remember. The distribution rate, whether let's just take USCL for example. Right now, the monthly distribution is 24.5 cents, right? If USCL gives you 20 cents 1 month instead of 24.5, or 10 cents, or 5 cents, or nothing, the distribution rate, how much the fund is actually giving out, has zero impact on the performance and total return of the fund. I repeat, zero impact on the total return and performance, because remember, that distribution, that 20 cents is coming out of the NAV, right? Of the net asset value of the fund, or the stock price, if you will. So if they abruptly stop the distribution, of course, it's going to have an impact on your yield and your income. We don't want that. But just remember that that amount is taken away from the NAV or the stock price on every X date. So if they give a penny less, a penny more, 5 cents less, 5 cents more, that's all coming from the NAV anyway. So you got to look at it more in that perspective. That will help you really understand that, distribution fluctuations are really not a big deal. Of course, it sucks when your income goes down. It's great when your income goes up. But in the grand scheme of things, in terms of performance and total returns, they don't have an impact. So what do you do? Right? We're down to what is the type of behavior you could do during a crash as a PII investor, and really as an investor in general. Well, you probably heard me say this a million times. There's only three things you could do. I repeat, there are three things you could do. So you have to understand that crashes are 100% normal, by the way, and they will continue to happen. The market will recover and another crash will happen. It's very important to really understand that. And there's nothing you could do about it, right? It's only how you react to it that you could control. So there's three things you could do, right? So number one is the worst thing is watch the news, get scared, panic, and start selling your assets and realizing losses. That is the worst thing you could do. It's called panic selling. It's negative and it's bad for a reason. And even though some people know not to do it, they still do it. They still get scared because they read something on Reddit, they watched some news program, and they believe that this is different. This time it's different. The end of the world is coming, etc., etc. Worst thing you could do. The second thing you could do, which is a good thing, is absolutely nothing. Ignore everything. Ignore the media. Ignore everyone with the doom and gloom. Just go outside, live your life. Don't do anything. Don't sell anything. Maybe not buy anything either. Just stay cool, calm, and collected, and don't do anything. I would say that's a good thing. Third thing is the best or great thing you could do is buy those cheaper shares, right? Dollar cost average down. Take the opportunity. It's a flash sale, right? When it's Boxing Day, everyone is happy. There's a frenzy and people are buying stuff. But when the stock market goes down, there's a crash of 10, 20, 30%. It's 30% off. People are scared to buy. It makes no sense. You're buying cheaper shares, which means you're increasing your yield. So that is the great thing you could do. Okay, so let me end with this, everyone. There is nothing you could do about a market crash. It's going to happen. And if you haven't gone through your first one, this is really going to be the most scary time, the first roller coaster ride of your life, right? When you go on a roller coaster ride for the first time, it's the scariest time. But after that, it's fun and you look forward to it, most likely, unless, you're queasy and you're going to vomit, etc. But, anyway, bad example. Good example, though. But it is a roller coaster ride and you have to go through it. And that is really when you're going to learn and really gain experience as an investor. And guess what? There's nothing you could do about it. Okay, there's so many things. So many things you'll read. Let me go in cash. Let me hold some cash. Let me go a little bit more defensive because a crash is coming. Let me do some swaps, go more into this sector, sell this. That is, in my opinion, the absolutely wrong thing to do. The best thing to do is stick to your plan and keep buying as much as you can every single month. So a little bit of courage, everyone, a little bit of bravery, okay, a little bit of stoicism. There is nothing you could do about it, and stop focusing or don't focus too much on the why. Why is the stock market crashing? Why is MSTE down 10%, but Bitcoin's only down 2%? Trust me, I'm going to give you some words of wisdom, some experience. The why, and this is from myself, someone who's asked myself why a bunch of times in the past. It's a complete waste of time and you're not going to find the answer. Okay, it's a complete waste of time. Trust me, been there, done that. Forget about the why and trying to figure out why. There's going to be so much content during the next crash, my prediction, of why the market is crashing, an explanation of why. Why doesn't matter. Okay, it's only what are you going to do about it that matters. The what is really that matters, right? So stop watching the media. It's always a glorious time. They always get better ratings. They're the winners in all this. And the people watching are really the losers. But remember that we are long-term. We're in it for the long term. Go through your first one. Break your cherry, if you will. And the next one will be much, much better. More boring. And you will embrace the next market crash. And be sad when it's over because the sale is over. Right? So hopefully this video was informative for you. I will be with you every step of the way. I will keep unveiling my portfolio every single month. If you want even more updates, make sure to become a member. My parents will go through the same exact thing. My grandparents' accounts, right? We're all in it for the long term. If you're interested to follow how their accounts are doing and how they will do during a stock market crash, make sure to become a member. Hit that little join button because as a member, you will see my family members' portfolios unveiled every month or two very, very popular videos. And join Blossom, join me on Blossom, follow my portfolio on Blossom every single day. So you could, maybe that'll help. Join the community there. I'll put the link in the video description below. You don't need to download the mobile app now. It's cool. If you use a computer, if you're more old school like me, if you just like the desktop, you don't really like those phone apps, you could join Blossom, follow my portfolio every single day. So I could talk until I'm blue in the face, but really what I'm going to be doing is my actions, right? I talk the talk, but I walk the walk. So during the next crash, keep watching, keep following for courage, and remember those three things, right? The worst thing, good thing, and the great thing. So make sure you're subscribed to the channel, because I'm going to be with you every step of the way. Hopefully you enjoyed the video. Give me a thumbs up. What do you think about market crashes, and what are you going to do when there's a market crash? Do you believe into that, let's go a little bit more defensive, or are you doing just like me and sticking to the plan and just buying more every single month, whether there's a crash or not? Let me know in the comment section below. Take care, everyone. See you next time.